Crypto ETFs offer a way for investors to diversify their portfolios without the risk of owning cryptocurrency directly. They track the prices of derivatives rather than actual cryptocurrencies. As a result, their share price rises when futures contracts prices rise and decreases when they fall. The funds are traded on traditional stock exchanges, making it easier for mainstream investors to buy and sell them through their regular brokerage accounts. The funds also benefit from regulatory oversight, which can reduce concerns about fraud and market manipulation. They track the price of a specific cryptocurrency. Crypto ETFs are a new way for investors to gain exposure to the price of cryptocurrencies. These funds are traded on traditional stock exchanges, making them easier for mainstream investors to access than the often unregulated crypto markets. This makes them an ideal investment option for people who want to add Bitcoin and other cryptocurrency assets to their portfolios, but do not have the time or desire to invest in individual cryptos directly. In addition, Bitcoin ETFs offer some protections that aren't available when investing in cryptos directly. For instance, because they're backed by physical bitcoins, they're less susceptible to the security risks that plague many of the world's unregulated crypto exchanges. This includes the potential for hacking and other financial loss. Additionally, Bitcoin ETFs trade on regulated exchanges, so they're subject to more thorough regulatory oversight than some of the unregulated crypto markets. However, while ETFs make it easier to invest in crypto, they're not a silver bullet for the volatility and speculative nature of the market. Like all investments, they can lose value if prices fall. In addition, some ETFs charge fees that can eat into your returns. This is why it's important to speak with a financial advisor before making any decisions. There are several different types of crypto ETFs, and each has its own advantages and disadvantages. For example, some track the price of a single cryptocurrency, which can be ideal for those with a specific interest in a coin's performance. Others track the price of a basket of coins, which is more suitable for people who want to diversify their holdings. Finally, some ETFs track the price of futures contracts, which are agreements to buy or sell a commodity at a specified date and price. Adding crypto to your portfolio can increase diversification and potentially boost returns. But be aware that crypto ETFs still carry some risks, including exposure to the volatile market and the potential for tracking errors. If you're considering adding a cryptocurrency to your portfolio, be sure to speak with a financial advisor about your unique circumstances and goals before making any decisions. They track the price of a specific asset. Crypto ETFs track the price of specific assets such as Bitcoin or Ethereum. This means that if the price of these currencies goes up, the price of the ETF will go up too. However, the tracking accuracy of these ETFs can vary from one fund to another. This is because different structures will give different results in terms of how closely the ETF reflects the price movements of its underlying asset. For example, some ETFs may hold physical Bitcoin or other crypto assets, while others will replicate the assets synthetically via derivatives. In addition, crypto ETFs can be bought and sold through traditional brokerage accounts, avoiding the complications and security risks associated with cryptocurrency exchanges, wallets, and private keys. This makes them a safer and more accessible way to invest in crypto assets. However, that doesn't mean they are risk-free. Investors should carefully consider their investment goals, risk tolerance, and market knowledge before investing in any crypto ETF. Unlike conventional ETFs, which focus on various types of assets, crypto ETFs specialize in digital currencies and the companies that operate in the blockchain industry. Many of these ETFs are listed on regulated stock exchanges, making it easy for investors to buy and sell them. The ETFs are also subject to regulatory scrutiny and compliance standards, which can provide a layer of security and transparency that is missing from unregulated cryptocurrency exchanges. Some of the most popular crypto ETFs are made up of stocks in companies that have invested in cryptocurrency or whose business involves crypto trading, mining, or other services. For example, the Schwab ETF GBKX tracks the performance of the Global X Blockchain Thematic Index and is made up of companies that may be involved in validating consensus mechanisms for blockchain or other distributed ledger technology. developing, distributing, or implementing applications of blockchain or other distributed technologies, including in new cryptocurrencies or digital assets, or providing other services related to the adoption or use of cryptocurrency or blockchain. Another benefit of crypto ETFs is that they are much easier to trade than individual cryptocurrencies, which can only be traded during normal market hours. However, it is important to remember that these funds still have fees and are exposed to hacking risks. They track the price of a specific sector. Cryptocurrency ETFs offer a more user-friendly way to invest in the cryptocurrency industry. They are designed to track the price of a specific sector rather than an individual cryptocurrency. These funds are listed on traditional exchanges and can be bought and sold like a regular stock. However, they are not suitable for all investors, and you should consult with a financial advisor before investing in one. Crypto ETFs enable mainstream investors to get exposure to the crypto market without having to deal with the complexities of managing wallets and keys. This can be helpful for investors who want to diversify their portfolios but don't have the time or expertise to assemble a basket of different cryptocurrencies on their own. They can also avoid the risk of losing their private keys, which has led to massive Bitcoin losses in the past. The new wave of crypto ETFs has been met with enthusiasm and demand from both traditional and retail investors. This surge is a sign that the industry is maturing and gaining acceptance in the finance world. Investors will be able to purchase and sell shares of these ETFs through their brokerage accounts, making them a convenient way to gain exposure to the cryptocurrency markets. They will also avoid the need to invest directly in individual cryptocurrencies, which can be difficult and costly to manage. Another benefit of the crypto ETF is that it can be traded during normal market hours. This will allow investors to get in and out of the market more quickly than if they were to buy and sell cryptocurrencies on their own. However, ETFs are not immune to the market volatility that is common in cryptocurrencies. While ETFs are a great way to diversify your investments, it's important to remember that they can still be volatile and have a high degree of risk. Therefore, they should only be a small part of your overall investment strategy. In addition, it is important to consider your investment goals and risk tolerance before adding any assets to your portfolio. A reputable financial advisor can help you choose the right crypto assets for your unique situation. They track the price of a specific company. Cryptocurrency ETFs are a way for investors to invest in the burgeoning crypto market without having to learn how to set up their own wallets and use exchanges. They also offer diversification by investing in multiple cryptocurrencies. This helps reduce the risk of losing money to a single cryptocurrency price drop. However, they still have higher fees than other ETFs and should be treated as a risky investment. Crypto ETFs provide exposure to a wide variety of digital currencies by investing in futures contracts tied to their price movements. These futures contracts are standardized agreements between two parties that obligate them to buy or sell a specified quantity of an asset on a specific day for a certain price. These agreements have a lot of the same attributes as other securities, and they are traded on stock exchanges like any other stock. These products are more regulated than actual cryptocurrencies, and they trade on regulated platforms. This gives them an edge over their unregulated counterparts, and it may help them gain acceptance by major institutions such as pension funds. This could be a huge benefit for the crypto industry, especially since it would make it easier for investors to take on this risky asset class. One downside of crypto ETFs is that they sacrifice one key aspect of cryptocurrencies: decentralization. This is because crypto ETFs require a custodian to hold their assets, which can be vulnerable to hacking and theft. While this is better than having your own wallets and exchanges, it limits the level of control you have over your investments. Additionally, the underlying assets of these ETFs are often not as liquid as the individual cryptocurrencies themselves. This means that you may have to wait for some time before buying or selling your shares. Also, most crypto ETFs are only traded during regular market hours. Finally, the taxes on crypto ETFs are typically not as favorable as those on individual cryptocurrencies. For these reasons, investors should seek professional advice before investing in these vehicles. However, the recent growth of crypto ETFs is an encouraging sign for the future of this volatile market.